So welcome back to chapter 2. This is objective 2, so hopefully you've already gone through the video for objective 1. We're going to go through and continue talking about the accounts and specifically the sides of the accounts. What do debit and credit mean, and double entry accounting and T accounts. Now before we get into, let me say something here. One thing I always tell my students is that part of what makes accounting so hard is that we use a lot of terms in accounting that we hear people use in everyday language. But in everyday kind of normal language, they're using them in a different way. I always say incorrect because obviously I think accounting is correct and everybody that's different is incorrect. But they're using terms in a different way. So one of the things you have to be very cognizant of, you have to be very careful of, is that when we're learning these terms, you're learning the correct definition and you don't just default because your brain wants to default back to what you already know. And I use this as an example because debit is one of the terms that we're getting ready to mean. And most of us, our brain is automatically going to think debit card, we spent money. Except that in accounting, that is not what debit means at all. So you really have to be very conscious of the fact that you're learning words that you already know, but they have a very, very different meaning than what you think they do. So we've talked a little bit about double entry accounting. We said that this is set up by Luca Pacioli and that Venetian monk in the 14th century. And what it means is that the accounting equation always has to be in balance. So at least two things have to be affected. So when we walk through that transaction analysis in chapter 1, we talked about that. We talked about how we had to make sure that the equation was always balanced. What this means more specifically is that we always have to have at least two accounts that are affected. And again, the equation has to balance. The overall equation has to balance. So when we talk about an account, we keep an account in what's called a ledger. And if you want to think of it in a non-computerized system, a ledger is basically a giant book. And on every page is a different account written. So maybe on the first page it says cash, and then you keep a list of all your increases and decreases in cash. And then the next page maybe says accounts receivable, and you keep track of all of the increases and decreases in accounts receivable, and so on and so forth. And on each of those pages is drawn a giant T, as in a T account. Now the left side of the T account is called the debit side. Debit does not mean good. Debit does not mean bad. Debit does not mean we spent money. Debit simply means left side. Now, you'll notice that it's abbreviated DR, and there's not an R in the word debit. Debit is a shortened form of the word debenture, which does have an R in it. The right side of the account is called the credit side. Credit does not mean good. Credit does not mean bad. Credit does not mean debt. Credit simply means right side. At some point in my career, I was told that debit and credit are actually the Latin words for left and right, which makes a lot of sense. Turns out that's not really true, but I like the story because it makes sense that that's what it's called, that's why they're called that. But debit really just means left and credit really just means right. So you need to forget everything that you think you know about debit and credit. I always tell students, take a big Sharpie and on your left hand write debit and on your right hand write credit. And you're going to use those interchangeably. So you'll be driving in the car and with your friend and say, you want to take a debit turn up here. Oh, I mean left, because that's all it means is debit just means left, credit just means right. So when we say we're going to debit this particular account, it means we're going to put it on the left side. Or we say we're going to credit this particular account, it just means put it on the right side. Now, certain accounts get increased on the debit side and decreased on the credit side, and certain accounts get increased on the credit side and decreased on the debit side. And I'm going to explain in a minute exactly which ones and how you can remember it. But the cardinal rule of accounting is that debits must always equal credits. So anytime you put a debit in one account, you have to put a credit in the other account so that they equal. So this is huge. You want to star, highlight, underline, I'm going to highlight here on the notes that anytime we have a debit in one account, we have to have an equal credit in another account. Debits must always equal credit. So I want you to star, highlight, triple underline, draw a squiggly box around that statement in your notes. That's vitally important. If your debits don't equal credits, you might as well give up now. Nothing's ever going to work out correctly. Now, when we talk about what's called the normal balance of an account, that is simply the side that increases the account. So some accounts have a normal debit balance, meaning they get increased on the debit side and decreased on the credit side. And some accounts have a normal credit balance, meaning they get increased on the credit side and decreased on the debit side. So if you look at our expanded accounting equation that's here on our screen, we see that on the left side of the equation, assets have a normal debit balance, meaning they get increased on the debit side and decreased on the credit side. Liabilities and most equity accounts have a normal credit balance, meaning they get increased on the credit side and decreased on the debit side. So if it's on the left side of the equation, it has a debit balance, normal balance. And if it's on the right side of the equation, it has a normal credit balance. The two exceptions to that, though, are dividends and expenses, because those reduce retained earnings and therefore reduce equity. They're going to have the opposite normal balance. So while everything on the right side of the equation has a normal credit balance, the things that reduce equity, dividends and expenses, have a normal debit balance. They get increased on the debit side and decreased on the credit side. So the mnemonic aid reveille is how I learned normal balances of account 100 years ago when I took this accounting class in college. So I got my bachelor's degree from Sam Houston State University in Huntsville. Go Bearcats, rawr. But my professor, my very favorite professor that I took as many of my accounting classes from as possible, had gotten his degree from A&M. So he was an Aggie through and through, and this is the way he was taught normal balances, and this is the way he taught me. So we had the mnemonic aid reveille. And the idea is, the story goes, and again, if those of you that are Aggies, you can correct me if I'm wrong here, but this is the way the story goes. Back when A&M was first a school and they first started playing football, they were at a football game one day and the Aggies were just getting beat up. And so you know that there's 11 football players on the field at any given time, and suddenly we get down to they're just getting beat up and they're getting hurt and they're carting the Aggies off the field, and suddenly we're down to we have no more football players on the sidelines. And somebody gets hurt. So now we're down to just 10 players and we've got nobody else to put in for them. And so one of the students who was in the student section jumps up and runs down on the field and says, I'll be the next person. I'll fill in. And no helmet, no pads, no nothing, just fills in for them. And so this is the story that I was told is the impetus of the 12th Man Foundation. So if you see people driving around and they have this 12th Man Foundation sticker in the back of their truck, that's what that's for. So if you ever go to an A&M football game, you'll notice that the students stand during the whole game. They only sit when the opposing team's band is playing at halftime. And it symbolizes their membership in the 12th man, that they're always ready and willing and able to jump in and help their fellow Aggies should they need help. Well, Reveille is the little dog. She's not very little, but she's the dog, she's the mascot, and she's the leader of the 12th man. So being a good Aggie, you pledge your allegiance to Reveille. Now this is not how you spell aid and it's not how you spell Reveille, but it works for our purposes here. So if we were to think of this as a T account, we could say that assets, dividends and expenses, ADE, assets, dividends and expenses, have a normal debit balance. They get increased on the debit side and decreased on the credit side. Revenues, The O stands for owner's equity. So remember, owners, stockholders, shareholders all mean the same thing. So owner's equity. So if we think of it, remember we said that owner's equity, stockholders' equity, shareholders' equity is made up of really two main parts, common stock and retained earnings. And then liabilities, they all have a normal credit balance, which means they get increased on the credit side and decreased on the debit side. So I always encourage students, you want to write aid readily across the top of your homework page, your notes page, whatever you're working problems out on, so that you can think through, okay, this is an asset, it's going up, I need to debit it. This is a revenue, it's going up, I need to credit it. This is a liability, it's going down, I need to debit it. You can think through that thought process. Now, I do want to give you a little word of advice, if I can. And again, I apologize, I do not have a touchscreen computer, and it's very hard for me to write on this, but I'll do my best. So assets go both up and down. We can get more assets, we can get less assets. So we're going to make assets go up on the left, and they're going to go down on the right, on the credit side. Dividends, it turns out, they just go up. We either paid the dividends to the owners or we didn't, but we're not going to pay them and take them back. So dividends just get debited. We're never going to credit a dividend. I say never. There's one time a year that we're going to credit a dividend. And by one time, I mean literally only one time a year are we ever going to credit a dividend. So anytime we pay dividends, we're just going to think debit dividend. Same thing with expenses. An expense, remember, is that cost of providing a good or service. Another way to think of it is an asset that's used up in the production of revenue. We either used up that asset or we didn't, but we're not going to use it up and then non-use it up. Okay, so expenses are always debited. We never credit an expense. Never, ever, 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 except for that one time a year. So anytime we have an expense, we automatically think, ooh, we're going to debit that. Okay. Now, on the credit side, revenues, remember, we earn revenues by providing a good or service. We are always going to credit revenues. We're never going to debit them. Never, ever, 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 except for that one time a year. Literally only one time a year. So revenue is money that we've earned. We've either earned the money or we haven't earned it, but we're not going to earn it, right? Like I either did the work for you, I mowed your grass, I cut your hair, I babysit your kid, or I didn't. But I'm not going to mow your grass and then be like, nope, I'm going to take that back. Now, even if the customer doesn't pay us, we still earned it, so we still get to call it revenue. So anytime we see revenue, we need to automatically think credit. Same thing with owner's equity. Owner's equities only go up. We're never going to debit common stock. We are going to debit retained earnings, but maybe we might debit retained earnings, but it would only be one time a year. So we're only going to credit common stock. We're mostly only going to credit retained earnings. Now, liabilities do both. They go up, we incur debt, we pay debt off, they go down. So they can go up on the right side or down on the debit side. So really, assets and liabilities are the only accounts that go both ways. Dividends and expenses are always, always, always debited. Revenues and owner's equity, common stock are always, always, always credited. Assets and liabilities are kind of the only ones that you have to figure out. They're the only ones that go both ways. So again, what if we decide, for example, cash has a normal debit balance? So that means to increase it, I say I'm going to debit this cash account. So if you remember back, and we're going to look at this in a minute when we get to learning objective 3, our first transaction we did was Sheena Bright gave us a check for $30,000. I'm going to debit cash because cash has a normal debit balance, and I'm going to increase it. So I'm going to stick that on the left side, on the debit side, to debit that account. Then in the second transaction, when I bought land for $20,000 cash, I credited the cash account, or I will credit the cash account to reduce it. So I'm just going to stick that $20,000 on the credit side to reduce it. So now I can look at the overall cash balance. You can see we've done a few more transactions here. I have debits, which are increases to the cash account that total $35,500. I have credits, which are decreases to the cash account that total $23,200. So to find the balance in the account, I'm just going to take the difference in the sides, the difference between the total debits and the difference between the total credits, and I put the difference on the largest side. So since the debit side has a larger balance than the credit side, I take the difference of $12,300 and I put it on the debit side. Now, normally the balance in cash will be on the debit side. That's why we say assets have a normal debit balance. Is it possible to have an abnormal balance in an account? Well, I'm going to ask, have you ever been overdrawn in your bank account? When I ask this in real class, I usually have people that kind of like look around and maybe one brave person will raise their hand. I'm going to say, you know what? I've been overdrawn. I've had an abnormal balance. I've had more credits than I had debits. So we don't say in accounting that we have a negative balance. We would say we had a credit balance. And a credit balance in an account that normally has a debit balance is bad, right? We don't say, though, that we had a negative balance. It's just that that balance would be on the credit side as opposed to being on the debit side. But normally, I'm not overdrawn, so normally I have a debit balance. Now notice that we have our single line here. Single line means subtotal, so whenever I'm going to balance the account out, I don't do it after every transaction. Maybe I'll do it at the end of the day or the end of the week or the end of the month. I put a single line and then I calculate the balance and I put it on the side that the largest side.